Bonds flash biggest recession sign since before financial crisis. Federal Reserve Chairman Jerome Powell's assertion this week that the U.S. economy remains strong is facing a stern test from the bond market. In fact, government fixed income yields are delivering, by one measure, a possible recession indication that hasn't happened since 2007. The spread, or yield curve, between the 3-month and 10-year Treasury notes just broke the longest streak ever of being above 10 basis points or 0.1 percentage points. The two maturities, economists see the yield compression as a dark signal for an economy coming off its best year since the recovery began in mid-2009. Yield. Short-term yields moving ahead of their longer-duration counterparts is seen as a sign that growth will be higher now than it will be in the future. New York Fed. The Federal Open Market Committee, which sets monetary policy for the Fed, said Wednesday that likely for at least the rest of the year unless economic conditions change. Powell said the U.S. economy is in related video. A U.S. could be in recession by mid-2020, strategist says. Bond market investors are showing they think growth could be a good deal beneath even those tepid levels. Financial markets, all. Like other financial market observers, Rosenberg noted the diverse reactions between the bond and stock markets. Fixed income yields are falling, indicating lower growth, while there's some indication in the market that the Fed's move yesterday to telegraph a decidedly dovish stance could help widen the spread somewhat. However, the challenges for the economy remain.
Raindrop, truck top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that.